Hi and welcome to section 3.3 for Econ 1 on the AQA exam board. Today we're going to be looking at production in both the short run and the long run. We will also be looking at fixed costs and variable costs. In economics we have various time periods. The main two time periods for the production process are the short run and the long run. In the short run, at least one factor of production is fixed. We usually assume that this factor of production is capital. In the long run, all of the factors of production are variable. So in the short run, at least one factor of production is fixed, and in the long run, no factors of production are fixed. All the factors of production are variable. So now let's move on to the type of cost for firms. For firms, there are two types of costs that are needed to be known at AS. These costs are fixed costs and variable costs. But what actually are fixed costs? Fixed costs do not change with the level of production and are expenses that the company has to pay independent of the business activity. One example is rent. Suppose that a firm had to pay a rent of £40,000 a month for a factory. It still has to pay this rent whether it produces at full capacity or if it produces nothing. Other examples of fixed costs include business rates, staff that are paid salaries, and depreciation of capital that is down to age, not use. With fixed costs, we can split them down into total fixed costs and average fixed costs. Total fixed costs are the sum of all the fixed costs for a firm. Average fixed costs are the total fixed costs divided by output. Here we have an example of a go-karting company with the following fixed costs. Rent is £20,000, staff salaries are £15,000, and the go-karting company has to pay business rates of £5,000. So the total fixed cost is the sum of all of these costs. So we do 20,000 plus 15,000 plus 5,000, which gives you a total fixed cost of 40,000. Here we have a table that has output rising from 0 to 1,000. The total fixed costs are independent of output. Hence why total fixed costs are always £40,000 whether the firm produces 0 units or 1,000 units. Average fixed costs fall as the firm produces more go-karts, but the total fixed costs remain the same, it's just that these fixed costs are spread over more units. So we can see that when 100 go-karts are produced, the average fixed cost is £400. But when 1,000 go-karts are produced, the average fixed cost falls to £40. This is because the fixed costs are spread over more units. Let's have a look at total fixed costs and average fixed costs on a diagram. The diagram here has costs on the y-axis and output on the x-axis. Total fixed costs will always be the same and are not dependent on the output level. So here we can see total fixed cost for our go-karting company was £40,000, and this is represented by the purple line. And average fixed costs fall as the firm produces more output as the fixed costs are spread over more units. The average fixed cost line is the black line that starts at an output of 1 and slopes downwards. Fixed costs are one of the reasons why firms can experience economies of scale. This is because as the firm produces more goods or services, the fixed costs are spread over more units. So as we saw with our go-karting example, 200 go-karts has an average fixed cost of £200. When the firm then increases their output to 1,000 go-karts, the average fixed cost falls to £40. The fall in fixed costs allows the firm to charge lower prices, become more profitable, and more competitive. However, it is worth noting that fixed costs are only fixed over a certain range of production. As you increase production, you may reach the capacity of your factory, so fixed costs will have to increase to accommodate the increase in production. Suppose that our go-kart factory could only produce a maximum of 2,000 go-karts, and the firm wanted to increase production to 2,500. This would result in the firm having to rent or buy a new factory, which would then increase the firm's total fixed cost, and thus affect the average fixed cost. So fixed costs are only fixed over a certain range of production. The other type of costs that firms experience are variable costs. These costs depend on the level of production. Variable costs increase as a firm produces more output, and they fall as a firm reduces the output that they produce. If no output is produced, the variable cost will be zero. The firm will still experience fixed costs, as fixed costs do not change with respect to the level of production, but the variable cost will be zero. Variable costs include materials and labour costs which are necessary to complete production. These labour costs come from those labourers that are on hourly wages rather than salaries, as salaries count as a fixed cost. Let's take an example of a pizzeria. A pizzeria would have the variable cost of anything that is needed to make a pizza, such as flour, yeast, olive oil, cheese, ham, pepperoni, the electricity that is used for production, the labour that makes the pizza, the labour that's on an hourly wage, not a salary, and the capital depreciation of the machine. These would all count as variable costs for the pizzeria. So with depreciation of machines, there is two ways that machines can be depreciated. One is age, and the second way is use. The perfect example is a car. Suppose that we had a 1-year-old car that has done 0 miles. This 1-year-old car will be worth less than a new car because it is 1 year old. Now suppose that we have a 1-year-old car that has done 20,000 miles. The use of the car by doing 20,000 miles makes the car less valuable. This is because certain components on the car have been used and may need to be replaced in the future, such as the tyres have done 20,000 miles and may need to be replaced soon. So our 1-year-old car that has done 20,000 miles will be worth less than just a 1-year-old car that has done 0 miles. This used car that has done 20,000 miles has two types of depreciation. One is the depreciation of age, and the second one is the depreciation of use. Depreciation of age would count as a fixed cost, and depreciation from use will count as a variable cost because it is dependent on how much you use that car or that machine. But why do we care about fixed costs and variable costs and total costs? Well, managers and owners of businesses need to have an idea about their fixed costs and variable costs so that they know how much they need to charge for their good or service if they increase or decrease their output. Total costs are the sum of all the costs for the firm. They are worked out by adding the total fixed cost to the total variable cost. Average total cost is the total cost divided by the output level. So we do total cost divided by output.